Welcome to the Stock Market Palantir. Today, we are going to talk about MNDR.
Right.
This stock, Mobile Health Network Solutions, has been nothing short of a spectacle in late 2025. It's a Singapore-based, NASDAQ-listed microcap, and it has exhibited just extreme volatility following a year of, intense corporate restructuring. The crucial context here is the radical strategic pivot. The company is moving away from a contracting legacy telehealth business, which saw its revenues plunge by 45.3%, and is instead attempting to shift into a high capital intensity focus on artificial intelligence infrastructure, specifically data centers in Southeast Asia.
In that pivot, while you could argue it's necessary given the collapse of their core model, it creates this enormous and I'd say potentially manufactured disconnect between market value and what they've announced. So the central question we have to wrestle with is whether this dramatic strategic shift represents a legitimate asset-backed turnaround poised for, a technical re-rating, or if these intense corporate maneuvers are fundamentally a mechanism for financial engineering designed only to manage the company's severe structural distress and the inevitable risk of catastrophic dilution.
I think you're focusing a bit too much on the legacy issues there and overlooking the powerful technical reality and the inherent value that's being injected. I hold the MNDR is currently an undervalued, high-risk special situation, perfectly poised for a severe technical re-rating. And that's driven by strategic AI assets and an extremely favorable market microstructure, a tinderbox, if you will.
See, I come at it from a different way. I believe MNDR is structurally distressed. It's utilizing these high-profile transformative announcements and market opacity primarily to manage a severe dilution overhang, and frankly to justify acquiring assets that fundamentally outstrip their financial capacity. This is less a strategic pivot and more a desperate attempt to swap out a failed business model for a high-risk reverse merger.
Okay, well, let's look first at the case for re-rating and asset value. The strategic pivot toward AI infrastructure, specifically data center investment in Malaysia, is timely. It's leveraging this massive macro tailwind of regional data center expansion, but the true evidence of value is in the acquisition structure itself. The Memorandum of Understanding to acquire data center assets is valued at up to $120 million. Now, this figure is critical because it provides a clear, credible anchor for future valuation.
An anchor or an illusion?
An anchor. To fund this, the company proposed issuing 3 million new Class A shares to the vendors. So if you divide that maximum acquisition value of $120 million by the 3 million shares issued, the deal mechanism effectively implies an internal share price of $40 per share. This figure, though theoretical, I'll grant you, establishes a powerful internal floor for the value of the assets being introduced. It signals a massive premium to the current trading price. Furthermore, the current technical data suggests the market is structurally primed for a spike. We have an extremely low reported float, approximately 937,000 shares post-split. The cost to borrow shares hovers near 20%, currently at 19.78%. When you combine that with a high days to cover ratio of 5.12 days, the stock is highly susceptible to a short squeeze upon any positive catalyst. And the recent insider purchase by co-CEO Dr. Teo Puipoi on November 17th also acts as a psychological stabilizer, signaling management confidence near the $1.60 range. The technical ingredients for a sudden price dislocation are all there.
I'm sorry, but I just don't buy that the implied $40 price is a meaningful valuation floor. Not at all. Nor that the technical setup outweighs the catastrophic structural risk. The valuation disconnect is alarming to the point of absurdity. They are acquiring an asset valued at nearly 45 times the company's existing $2.71 million market capitalization. That suggests structural manipulation of the public vehicle's value, not organic growth. Let's look at their corporate history as evidence of fundamental distress. MNDR has executed 2 reverse stock splits within 7 months, a cumulative 1-for-40 consolidation. These actions severely erode investor trust and are, generally defensive maneuvers signaling that the underlying business is failing to meet basic NASDAQ listing requirements. The structural mechanism is the key risk, which I think fundamentally outweighs any temporary squeeze potential. While the outstanding float is tiny now, the company has retained the authority to issue an incredible 156,250,000 or potentially even 312,500,000 ordinary shares. This represents a potential dilution overhang of over 15,000% compared to the existing float. This massive capacity is the structural sword of Damocles, facilitating future toxic financing or further high-risk, dilutive acquisitions. The move to acquire high-capital physical data centers explicitly contradicts their prior asset-light virtual platform strategy. It just suggests a tactical, buzzword-compliant strategy designed only to attract capital, not a coherent, financially feasible roadmap.
I see why you'd highlight the historical splits and the strategic shift, but I would frame that $40 implied share price not just as some arbitrary number, but as a crucial legal and negotiation floor. It's what the asset vendors demanded to place their assets, which have tangible physical value, into a struggling public vehicle. This valuation is necessary to secure the very assets that keep the company viable.
Okay, but we have to detail the structural implications of that 3 million share issuance for the Malaysian acquisition. Since the existing post-split float is only about 1 million shares, the Malaysian vendors, PPG, PP Grid, would gain controlling interest, owning approximately 75% of the post-issuance equity. So this looks less like an acquisition by MNDR and far more like a corporate inversion or reverse merger, where the public shell is being taken over by the private data center entity, using highly valued shares as currency. They're buying the listing status, not vice versa. This fundamentally changes the nature of the investment.
I acknowledge the reverse merger dynamic. It is undeniable that the control is shifting, but let me give you a different perspective. This inversion structure is often the only viable path for a microcap shell to inject meaningful, high-value performing assets. If MNDR tried to raise $120 million in cash to acquire these assets, it would be impossible. By paying in highly valued paper, they managed to transform their balance sheet instantly. Furthermore, the headline figure is up to $120 million. This phrasing strongly suggests an earn-out structure, meaning the acquisition value is contingent upon the data centers achieving specific performance or revenue milestones over several years. This mitigates immediate financial risk and provides a built-in mechanism for vendor accountability, validating the asset value only if the strategic vision succeeds.
Even if we accept the potential mitigation offered by a performance-based earnout, we must then turn to the operational plumbing of the market itself. To what extent do technical market anomalies, specifically dark pool shorting and fails to deliver, or FTDs, validate the aggressive squeeze narrative versus merely signaling fundamental distress and, frankly, manipulation by powerful actors?
The persistence and the sheer magnitude of FTDs, particularly in a scenario where the float is sub 1 million shares, are fundamental indicators of extreme scarcity, and they validate the mandatory buying pressure thesis. Look at the specific data following the reverse split. On October 1st, 2025, 30,128 shares failed to settle. That represents a staggering 3.2% of the entire outstanding float failing to settle in a single day. This confirms scarcity. Crucially, the mandatory T+35 reconciliation rule means those failures must be covered, fueling mandatory, non-discretionary buying pressure over the following weeks. This forced buying into a thin bid-ask book, combined with the cost to borrow near 20%, is precisely why this setup is so volatile. The aggressive bearish pressure, evidenced by the fact we saw 65.5% off-exchange short volume on November 11th, confirms that large players are betting heavily against the restructuring, which only exacerbates the potential for a short covering rally.
That's a compelling argument based on the mechanics of mandatory reconciliation. Sure, but we have to consider the intentional use of market opacity. While FTDs and high off-exchange volume exist, this environment often challenges efficient price discovery, benefiting those who can manage inventory precisely. Sophisticated market makers are not simply passive short sellers caught in a trap. They may be using these dark pools and internalizers for highly efficient hedging and inventory management to suppress sharp price breakouts. They can continuously refresh shorts in the dark pools to manage their risk, often making the reliance on a quick retail-driven squeeze narrative highly speculative and, well, fragile. The technical mechanism for a squeeze is certainly present, but its execution relies on market dynamics that seem fundamentally managed to suppress volatility in the long run, protecting sophisticated capital from the risk of the float vanishing. The illiquidity cuts both ways. It makes price spikes dramatic, but it also makes sustained price defense easier for large participants.
But you still have to address the core operational viability.
Exactly. We have to step back from the technical mechanics and address that. Is the AI pivot featuring proprietary models like PhiGPT and ICO, is that credible given the company's dire financial state and intense capital requirements? The company reported a net loss of $3.4 million against only $7.7 million in dwindling revenue for the latest period. Developing proprietary large language models requires world-class talent and massive computational resources, and acquiring high-capital physical data centers requires continuous, aggressive CapEx. The typical cost to establish a competitive data center infrastructure capable of hosting LLMs runs into the tens of millions, far exceeding their current revenue stream. I mean, does a company with their burn rate and structural insolvency really have the R&D budget to compete with established medical AI firms and avoid catastrophic cash burn? The financial capability is simply structurally absent.
I see why you're skeptical of the R&D budget based on the prior financial statements, but the strategic intent justifies the risk. The goal is vertical integration, which is necessary for long-term survival in this sector. Hosting their own AI models, the PhiGPT, in the newly acquired Malaysian data centers drastically reduces massive long-term inference costs, and perhaps more importantly ensures data sovereignty and security, which is a key regulatory concern in healthcare data across Southeast Asia. This move, while capital-intensive upfront, is designed to reduce recurring operational expenses down the line. Moreover, the company is proving it can secure external validation and diversification efforts. We see the partnership for Ghana expansion with the Josbong group of companies, and the collaboration with Brands for Good for corporate wellness. Even the small but crucial Indo-Pacific investment of $900,000 demonstrates successful, albeit limited, capital raising during this highly volatile restructuring phase. It shows they're diversifying away from the saturated Singapore market and into high-growth, underserved areas.
I'm not convinced by that line of reasoning. Securing $900,000 for diversification doesn't come close to funding the continuous capital expenditures needed for data centers and LLM development. We are talking about cash needs that could easily exceed $50 million in the next 18 months just to execute the pivot. That authorized share capacity, those 156 million shares, exists precisely to fund this projected catastrophic cash burn. This leads directly back to the dilution spiral risk. The AI pivot is an excellent buzzword strategy to attract speculative funds, but the financial capability to execute against established AI giants is structurally absent without resorting to financing mechanisms that will crush current equity holders.
But that's the binary nature of the bet.
Exactly. And we also have to consider the timeline. The legacy telehealth business is contracting rapidly. The AI pivot and data center integration are complex cross-border projects that take time to generate meaningful revenue. During that gap, the company remains highly susceptible to aggressive short attacks, forcing management to utilize the dilution capacity simply to keep the lights on and maintain listing compliance. The entire setup is binary. Either the $120 million asset injection fully transforms the balance sheet and operational narrative, or the dilution risk materializes and wipes out the existing float.
To summarize my position, while the risks, specifically the regulatory and financial complexity, are undeniable, the company has secured a pathway to acquire critical, tangible assets, and it has created a structural setup with a low flow, high borrow cost, and significant FTDs that makes it susceptible to a severe technical dislocation. The $40 theoretical deal valuation provides a necessary valuation floor for rereading, making MNDR a powerful speculative bet on successful asset-backed restructuring and a resolution of the current short squeeze conditions.
And I'll restate that the structural risks, the extreme authorized share capacity, and the fundamental financial distress masked by extreme volatile trading and opaque market mechanics suggest the overwhelming primary outcome is heavy dilution. Investors here are buying a very high-risk option on a complex binary cross-border restructuring and control transfer.
They must weigh the compelling technical opportunity created by illiquidity against the existential solvency risk driven by the need for a massive capital infusion.
Ultimately, whether one focuses on the immediate technical setup, the T+35 rules, and the high cost to borrow, or the long-term threat of structural dilution, that defines the investment thesis here. It is a textbook case of needing to weigh market mechanics against fundamental solvency and the governance risks inherent in a reverse merger.
Agreed.
Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.